thank you traders for showing up today. And I'm excited about the presentation today. I'm going to be talking about options and about option pricing. I'm going to focus in on some elements about how options are priced and what I call the magic of math, and how you can put that that magic of math to work in your favor, how you can create an edge just by understanding how options are priced and by choosing the right option contract. So please make this interactive. Ask questions as we go. I'll field them as I can. I'm going to also be looking at some live trades, and that probably leads me to just a quick disclaimer. I'm going to be looking at live trades. I'm going to show you some trades that I'm in right now, and I'll be happy to analyze any trade ideas that you have. But I'm a trader. I'm not a financial advisor. I'm not giving financial advice. You know, whether you take a trade or not, of course, that only you know what's appropriate for you. So I'm going to walk through this area. I'm going to talk about why the majority of option buyers lose money. So I'm going to talk about buying options. So I know there's lots of option strategies out there available. You know, you can be a seller of options, you can do spreads and all kinds of winged flying creatures. But I'm going to talk about buying options. And you know, you've probably heard this before. I hear the question, hey, don't 80-90% of option buyers lose money? That's probably true. Let's talk about how we can be in the 10 or 20% that make money, though, right? So we'll talk about why the majority of option buyers lose money. I'm going to talk about the three components of option pricing, what makes up the price of it, and then the magic of math, some simple arithmetic that'll put the odds on your side. I'm going to talk about why cheap option contracts can be very expensive. I get asked that question a lot. They go, Dean, you're buying a call contract for $1,000. I see they're over here for 50. Why don't you buy the cheap ones? Because they can be very expensive, right? I'm going to talk about how to be in the minority of people who actually win at buying option contracts. I'll share my current option trades, and I'll be happy to analyze any stock charts or option, stock charts and option plays on them that you're interested in toward the end of the presentation. So before we get started into the material, is this real? It's one thing to have some slides in PowerPoint and talk about an abstract concept, but here's my radar screen and trade station. Here are the option trades that I am in right now. We've got 7 open positions. 5 of those are in profit. And what I like to point out is the ones that are not in profit right now, and they still got potential, right? These could turn around and win. But the reality is some trades lose. If you're not willing to accept that, probably good to step back from the market. But what's important is the ones that are winning, once the trades start playing out, are winning much bigger than, and when I get stopped out, the losers are small, and when I get stopped out and eventually close the winners, they're big, right? And that math works. Big winners, small losers, and we can really do that with options. So this is real. I'm really trading these in my own account. And over time, my track record is on my website here, and I'll share that real quick. This is my website, followmetrades.com, and I try to just provide complete transparency about my results, the results I'm getting in my own account for my own money, right? Year on year, here's what we've been able to book. Year to date, the S&P 500 as of the 17th of September, so just about 12 days ago. We haven't closed the trade since then. We'll update it when we do. So the S&P was up 12%. We're up just about almost 20%, 19.34. So we're blowing away the S&P 500 by about 50%. And we provide complete transparency. There's a detail of every single trade I've taken 2017 year to date. And you can see not every trade wins, but there's the detail of it. And the point is, winners are bigger than the losers, right? We keep that payout ratio, the ratio of how much you win to how much you lose, as absolutely high as possible. And that's how we make profit. And just a side note, again, I believe in transparency, and we have our results audited by an external CPA firm, and you can click here and find out the details about that. Okay, so let's, hopefully that just keep it real, right? We're doing real trades and trying to be transparent about them. So now let's talk about the concept, get a little abstract. Okay. So let's just review, and this may be a really basic review for some folks, but for some, may not, be really interested in options, but not really understand what they are. So let's just do a real basic primer on what options are, right? An option is a contract, right? When you buy an option contract, you don't own stock, right? You own a contract. It gives the buyer of the option, the owner, or the holder of the contract the right, and this is really important, not the obligation, to buy or sell underlying asset, the stock, at a specified price called the strike price on or before a specified date called the expiration date. That's why it's called an option. As a buyer of an option, you have the option of exercising that contract, buying or selling the underlying asset at a predetermined price on or before the expiration date. And the cool thing about options is you never have to act on it. You never actually have to exercise it if things go well, right? If your plan comes to fruition, you never have to exit. You just go sell the contract because it's worth more later and you make a profit, right? That's what we're trying to do. Okay, so the seller, the person who wrote the contract, has a corresponding obligation. They have to do it. Their broker will make them do it, right? To fulfill the transaction, to buy or sell, if the owner exercises the option, right? There's two types of options, calls and puts. When you buy a call, you have the right to buy stock at a predetermined price before the expiration date. You have the right, but not the obligation. When you buy a put option, you have the right, but not the obligation to sell stock you don't even own. It's beautiful, right? Anytime before the expiration date. Pretty simple. And again, please ask questions or make comments as we go along. I'm keeping an eye on the questions window and I will field them real time. All right. Why do option buyers lose money most of the time? Why do we at least hear that, right? So the seller of an option contract receives money, right? You pay them money to buy the contract. But if they don't hold the underlying shares, if they are selling naked contracts, they have unlimited risk. I don't sleep well at night knowing that I have unlimited risk. I don't really like that, right? The buyer of an option contract, they pay money, right? We pay what's called a premium, right? And if we take no action, and if we let the contract expire worthless, we lose everything that we spent, 100% of it. But it's important, the buyer's risk is limited to what we spend on the contract. There is no other obligation or risk. If you go spend $1,000 on option contracts, pay that in premium, right? Your risk is $1,000. You cannot lose any more. Option sellers, if they don't hold the underlying shares and if they're not hedging in some other strategy, they have unlimited risk. They could lose more than they have in the trade. I don't really care for that, right? So you can obviously control your risk by how much you spend. If you go spend 100% of your trading account on option contracts and let them expire, you're gonna lose 100%. If you spend an amount that you can afford to lose, a pain-free amount of loss, that's pretty good, right? You can control your risk that way. Okay, so an option contract can be a depreciating asset. It does not have to be one. That is not a maxim. It is not universally true. Done correctly, it can be an appreciating asset that can gain value, and that's what we're trying to do, right? Majority of option buyers lose money because they buy the wrong contract. They don't use strategic risk control. They don't limit the amount they could lose. They don't manage the trade correctly, and they let the option contract expire worthless. Ouch. Lose 100% of what you got into the trade. I don't like it. I'm not going to let that happen. So let's be in the 10%, 10 or 20% minority of option buyers who are making money. Let's talk about how we do that. Okay, again, real basic here, but I want to just make sure everybody's on the same page. So the price of an option contract is called premium, right? Kind of like an insurance, that we pay. The amount we pay in for insurance is called a premium, right? That premium, the price of a contract, is made up of three components. Implied volatility, how much the market participants are bidding the price up or down based on their expectations of price movement in the underlying shares. Time, how much time is left on the contract before it expires. Someone says, Rebecca says the audio is breaking up. Is that happening for everybody, or is it just Rebecca? Maybe just a couple folks type in, can you hear me okay? Is everything good? Thumbs up, thumbs down. Good there, thank you. Okay, I'm just gonna press on, it's okay, thank you, Milo. Adatola. All right, I'm just gonna press on unless I hear different. Okay, price is made up from implied volatility. It's made up from time value, which is how much time's left on the contract. And it's also made up of the degree to which the contract, the strike price, is in or out of the money. The strike price versus the underlying price. That is super important, okay? Both time value and implied volatility are extrinsic values. Extrinsic meaning they're not part of the essential nature. They're outside. That value is coming from outside of the thing, outside the contract, right? Strike price versus the underlying price, whether it's in the money or out of the money, represents intrinsic value. That means it's belonging to the essential nature. It's the constitution of a thing. And an example I use here is a silver dollar, right? A silver dollar is always worth $1, right? It's a silver dollar. You can always take it to the bank or to a store and spend it and get $1 worth of goods or services. It may have additional value that is extrinsic because it's rare and collectors like it and it's in good condition, right? But it will always be worth $1. The extrinsic portion is outside of the actual value of a silver dollar. I hope that's a good example that you get your head around, all right? So here's a chart showing intrinsic value for a call option, that is in the money. So if you buy a call option with a strike price of $100, right, what that means is you have the right to buy shares at $100, right? If the current trading price of the stock is 120, it's got intrinsic value of 20 bucks a share. It is absolutely worth $20. If I got a contract because I can go buy things for $100 that are currently trading at $100, it's got $20 worth of value minimum, just like the silver dollar, right? Steve says, is it true when you buy an option you need to go out at least 60 days to give it enough time? You know, 60 days, what I do, I want to be out of the trade well before the final 30 days of the contract. So when I analyze a stock chart, I project how long I'm going to be in that trade, and I want to be out of it well before we get into the last 30 days. Okay, so that may be 60 days out, maybe 90, maybe longer. Okay, it depends on the time frame of the chart you're trading and the individual pattern that's going on. But we're going to talk about that in just a minute. We're going to show a chart on time decay. All right, good question. Okay, call option for a trade going up, right? $20 in the money. That's what that term means. It's $20 in the money. Here's a put option example. Price going down. You have a put contract, strike price of 125, meaning you can sell the stock at 125, and the price is currently at $95. That's pretty cool, right? How'd you like to sell something that's trading at 95 for 125? It's got an intrinsic value of $35. Okay, that's what we mean by in the money and intrinsic value. Let's look at a quick option chain real quick. We'll bring it up here on TradeStation. We're looking at it here on a current trade that I'm in. Let me see Steve's question. Is it also true you have to buy the option strike price to strike price from at the stock? No, you can buy any of these contracts you like, right? People are absolutely willing to sell you all these contracts. So we're looking here at SLCA. This is an option chain. This is all the March contracts, right? So they got the strike price down the middle here, $13, $14, $15, all the way up to 49 on this particular display. You can buy any of those you want. Okay. What I wanted to show here on this option chain is we're long on SLCA. So you can see there's a column here for extrinsic value and intrinsic value. And you can see that down here, current price is 31. So at 32, right, that is out of the money, and there is zero intrinsic value. It's got only extrinsic value based on implied volatility and time. The sum of intrinsic and extrinsic is going to be the actual price of the contract, and then there's a bid and ask right on either side of that. But the absolute current value of a contract is the sum of intrinsic plus extrinsic, and you can get this data here on most legitimate option chain presentations. All right. So sadly, the value of an option contract decays or depreciates over time, right? Because it has an expiration date, and that expiration date is approaching, right? And so the value, the time value of the contract goes down. Now it starts off somewhat slowly, and then it becomes an accelerating curve here in this region of fast time decay, and these are based on monthly options, right? Weekly options have their own curve, right? And so do leaps and stuff like that. But on a typical monthly contract, this last 30 days, we see this very steep time to, value decay over time, right? This is days till expiration. So we want to be out of this, right? Because even if we're right, even if the thing is increased in value, that went the way we thought, we bought a call option because we thought the thing was going up, it went up, it increased in value, and now it's maybe going sideways. You don't want to sit through this and lose value on your contract, right? You want to sell it, make your profit, okay? So that's how time decays on this. You have to be aware of it. As we showed on the option chain, the total value of an option contract, it's the sum of extrinsic and intrinsic value. Of course, there's a bid and an ask outside of that, right? But the current actual price is the sum of extrinsic, which is implied volatility in time, and intrinsic, which is the degree to which the contract strike price is in the money. Raymond says, not seeing the screen. I think I'm still projecting. I think it's all still good. If anybody else is having an issue, let me know. Otherwise, I will just continue. Looking at the little thumbnail here, it looks like I am projecting. So not sure, Raymond, maybe someone can help you out. It's fine there, says Milo. Good, thanks. All right. So the sum of the total value of an option contract, sum of extrinsic and extrinsic, right? An out of the money option contract, this is where it gets interesting. It has zero intrinsic value. If it's out of the money, it has zero intrinsic value. Its price is 100% comprised of extrinsic value, which is subject to and vulnerable to changes in implied volatility and changes in time. Okay. Time decay, changes in implied volatility only affect extrinsic value, the extrinsic portion of total price, right? Intrinsic is set, just like that silver dollar, right? It's set by the degree to which we are in the money. It cannot change. All right, G13 man says it looks good. Pavlo says he's waiting to see my screen. Hopefully you can see it. Pavlo, it's good to have you here. Pavlo's a longtime customer and a friend. I think the display's okay. I'm just going to keep going unless Renee tells me to stop. All right. Okay, I'm going to keep rocking it. All right. So you see the point here, right? That time decay and changes in implied volatility really only affect the extrinsic portion. So changes in the underlying price of the stock directly affect intrinsic value. So if we're in the money on a call option contract and price goes up, right? We expect the intrinsic. We don't expect it. It absolutely happens, right? If we're in the money with a call option contract and the stock price goes up, the intrinsic value absolutely goes up. Can't change it. Right? Can't avoid it. It's a good thing. All right. Here's the thing, the magic of math, before we get into it. And, I make a little play here on that movie from a few years back, right? But my big fat Greek helper is called delta. The Greek symbol, triangle, delta. And in terms of options, delta is a measurement of the change in an options premium, its value, resulting from a change in the underlying security. Value of delta ranges from negative 0.100 to 0 for puts and 0 to positive 1.00 for calls. The deeper a contract is in the money, the higher the delta. So the more we're in the money, the higher the delta, and the more that the price of the contract is going to change based on changes in the underlying shares. It's important, right? So when intrinsic price of the contract, intrinsic, in the money, right, the green portion here, if it's a higher proportion of your overall premium, then delta's higher, right? The total premium then is much more sensitive to changes in the underlying share price and less sensitive to time and implied volatility. Now, if we're buying calls or puts based on an expectation of a stock price that's going to go up for call contracts or down for put contracts, this is where we want to be, right? We want that value of that contract to be increasing so we can sell it later, right? In a low delta situation, extrinsic value is bigger, right? And we'll be at near zero delta, right, when it's all made up, when we're out of the money, right, with 100% of the value of the contract being extrinsic. So here's an example. If you think you're looking at this chart, right? And you go, oh, Gilead, it's sitting here at the high 70s. I think it's going to 90, right? What contract makes sense? What's called contract makes sense? One with a high delta and a high intrinsic value, one with low delta, low intrinsic value, or zero delta, right? The goal is that we want to go buy a contract, we want to have it appreciate in value the maximum amount, and then we want to go sell it before expiration, right? So it's obvious, right? We want to buy this high delta where intrinsic value is a much higher proportion of total premium than in extrinsic, right? Steve says, heard that when picking strike price, delta has to be 70 or better to make money. Is that true? I think 70 is a good baseline number. Absolutely. You really don't want to go below it. You definitely want to see if you can get more, right? The more delta, the better for a directional trade. Again, this isn't the only option strategies. People buy options for lots of reasons, to hedge existing positions, or they do, if they don't know which way things are going, they want a spread or a straddle, whatever, right? This is about directional trades, just like this chart where I go, I think Gilead's gonna rocket up to 90. What's the best play here? For me, it's buying a call. Has the lowest amount of risk and the highest potential for profit. Okay. So here's the trade, right? We got this Gilead. We think it's going to 90 bucks. We got some kind of rationale for that, some analysis method. So we think this is good. We're gonna go ahead and do a trade here on Gilead. So we got two options, right? We can go deep in the money, high delta. We could buy a strike price of $70. So 70's down here, current price up at like 79. So this thing's pretty deep in the money. It's got a delta of 0.87. That's high. That's nice. The value when I took this snapshot here about a month ago, the cost of a Gilead call option, right? December expiration. We want plenty of time. So the cost of that was $9.93 per share. So that's actually $9,900 per contract. Each contract's for 100 shares, right? So let's just make this evil. Let's just say make this equal, make it even. We're going to compare these two things. Let's say we're using a $100,000 account and we're willing to risk 2% of our accounts. We're going to spend about $2,000 on option contracts. So in this case, we buy two of them, and it cost us $1,986 bucks. We got $2,000, call it, in the market, in the trade. Okay. Now we could go buy cheap ones. We can go look and say December expiration, strike price of $95, out of the money, way out of the money, delta of 0.1, but they only cost 54 bucks, right? I can go buy a sack of those things. I can go buy 36 of those. And I've got roughly the same amount of money in the trade, at risk in the market, right? Over here I got 1986. Over here I got 1944. I just changed the number of contracts that I bought. And over here, what a bargain! I bought these for 54 bucks a piece. It's phenomenal. Maybe. Let's look at this. What happens? Okay, the result at the target price. If we were right in our chart analysis and Gilead went on to get up to 90 bucks, how does that play out? Well, the deep in the money contract, right, increased. We bought it for $9.93. It went up to $20.03. That's a 101.7% gain on our initial $2,000 investment. We made, we had gross proceeds of $4,000 to sell it, and we made 2,020 bucks. Wow, 101%. That's a home run, man, in anybody's book. How about these cheap ones? Well, they did okay, right? Gilead went up to 90. It was good. We were right. So these things increased from $54 per contract to $83 per contract. It's 53% gain. Well, not too bad. Not too bad, right? But what happens if it fell a little short, right? What happens if it fell a little short? Oh, this is totally different, isn't it? So what if Gilead only made it to $85? What if it only made it to 85 bucks? What happens here? Well, our deep in the money $70 strike still made money, still made 1,000 bucks, 51.4%. Oh no, what happened to our cheap one? it lost a boatload of money. It lost 70% of the trade. So here we are, same chart, right? Gilead, same exact price movement of the underlying asset, but the contract that we chose to trade it with had a huge impact on the outcome of the trade, didn't it? Losing 70% versus making 51%. And I use Gilead as an example because when I put these slides together, that's a trade we were actually in. And what actually happened with Gilead, let me pull it up here. It actually made it to $86, right? And so I took this snapshot, we were back here, right? So we actually won on this trade, right? Because I was trading those exact contract, the good one that I showed you, right? And we actually had a big win on Gilead. So that's a real trade. And that was really fun. So here's where I say cheap option contracts can be very expensive. Again, people ask me quite a bit in my trading room and various webinar stuff. Why are you spending $1,000 on a contract when there's a $54 contract? This is why, right here, right? Cheap contracts can be very expensive. You got to pick the right one, right? So just understanding some basic math and how pricing works on these things, I call it the magic, right? This is right here in front of you, the magic of math. Picking, again, underlying shares did the exact same thing, but what contract we were holding made all the difference in the world, from losing a painful amount of money to making some good money here. Any questions so far? Is this resonating? Is this good? I'm gonna show you now next a couple of my current favorite trades, and I'll be happy to look at any that you're interested in. Steve says, can you talk about LEAP? LEAP stands for what? A long time. I forgot what the acronym is, right? They're way out in time. They can be good for hedging and stuff. For directional trades like we're talking about here, they're a little expensive. So I don't think LEAP contracts are how I would trade a directional trade here. Again, most of my trades are lasting 4 to 6 weeks, so LEAP is not the right instrument. If you're hedging against like the last gentleman was talking about, a big correction coming in the SPY or something like that, that may be appropriate. Again, you have to weigh the cost of insurance or hedging against the returns in your portfolio. But yeah, LEAP is just way out in time. They're way out in time, like a year, 2 years, 3 years. Okay, hey Brad, thank you very much. Thank you very much. Okay, well, so here's how you win, right? Here's how to be in the winning 10% of people that win at the game of buying options. Make sure you have a high probability directional trade setup, up or down, based on whatever method that you're using to analyze charts. Use disciplined risk management. That comes from trade size and predetermined stop price. When you go into a trade, you got to know, it's one thing to think about how much could I win. What's really important is you think about how much could I lose if this trade fails? And is that a pain-free loss? Is that a tolerable loss that I'm willing to take and move on and it's not a setback? Right? You got to answer those questions, and the answer has to be yes before you take that trade. Otherwise, it could be disappointing and very painful and unpleasant. Right? So you got to win. You got to have a high probability directional trade management. You got to use disciplined risk management. Then use the magic of math. Right? Simple arithmetic. Put the odds of the trade, the right contract on your side. Deep in the money, high delta, plenty of time to hit the target, at least 30 days before expiration or more. There it is on one slide. Pretty easy, right? That's how you be in the winning 1%. And by the way, if you're wrong, trades lose, high probability directional trade setup, you go, oh, didn't make it, it went the other way. You got a predetermined stop, you get out, you lose a little bit, and you move on, right? To keep those winners big in proportion to the losers, and over time, you be a profitable trader. All right, let's back up from there. What I'm going to do is I'll show you my current favorite trade, one we just took this morning, and then I'll show you two. I'm feeling generous today. I'll show you two trades with option contracts that we're trading. Neeraj says or asks, with a higher delta, it makes the price of the options less sensitive to changes in implied volatility. That's absolutely right, because then it is less sensitive because the extrinsic value is a smaller overall part of the total option premium. So if there's change in implied volatility, it's going to have less of an impact on here than it would over here, right? For sure. Makes sense? Good question, though. Okay, so favorite trade number 1. This is a brand new one. US Silica, SLCA. So my chart analysis, I use a very simple version of Elliott Wave, and I also use Ichimoku Cloud and some extra indicators to help me confirm what's going on. So SLCA had obviously a big, massive run up. That's called an impulsive move, right? Big impulsive move up to 60 bucks. It had a really nice correction. After impulsive moves, we can expect a correction. It had a really good correction that met the rules. It retraced to a Fibonacci level, stayed above a key disqualifying level, and now we look at the continuation of that initial trend, right? That initial trend was up. That's the dominant trend, up, a really nice correction, and now we're looking at a continuation, and we can use Fibonacci extensions to project where this should go based on the previous price movements, and we expect there's a high probability of this getting up to between 53.35 and 71.59. Probability, not certainty, right? There's no certainty, but it has a high probability. So I'm in this trade. We got in at 30.61. That's this blue line. This is my current stop loss level, 26.72, which is sitting at a good support level, right? Because in an uptrend, which is starting, we have higher highs, higher lows. That's where my stop's sitting, higher low, higher highs, higher lows. We go to new highs, stop's going to go there. Okay, it's up above the Ichimoku cloud. My momentum oscillator is positive. My trend filter is positive. This looks good to go. So SLCA is long. It's going to take a little bit of time to play out. This is a slow moving, this last impulsive move it started back in March of 16, and it took until just about March of this year. It took a year, right? Now the corrective move was shorter, right? So this one, we're going to be in this trade, probably 2 to 3 months. And it's going to move up and down and up and down. You don't freak out if it pulls back a little bit. Overall, the price movement is up. So we're going to trade this with a March contract. And we're going to trade it with the March. The contract I like on this one is the $26 strike. It's got a delta of 75. Now you can go get higher delta, but you're going to have to pay for it. So we paid $7, so it's up. We're already in profit on this, but I still like the March 26 strike price call for the SLCA trade. All right, you're going to pay between the bid 720, the ask is 740, so you're probably going to pay about around 730 bucks per contract right now, and that's got some room to run, baby. That one looks really good. So that's the first one. I'll give you one more. I'm short on Apple. Apple's had an amazing run. It's been an 18-month run. Huge profit in it. There's something going on here that we haven't seen before, right? And we see a good bearish correction starting to set up on Apple with a target down between these two Fibonacci retracement lines. I got a price target set just in the top here to be a little conservative. So I got a price target on this trade at 135, right? We got short here at 150, 113. Yeah, it pulled up a couple days. So what, right? That's price movement. Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Look how it's reversing right under the Ichimoku cloud, which is projecting resistance, and it's projecting it pretty well. So this will take 3, 4, 5 weeks to play out, right? So I'm not concerned about one individual price bar. I'm looking at the big picture. Right. The big picture is this thing is getting ready to correct big time. So we're trading Apple to the short side, and I am trading that with a January expiration date 170 put contract. Okay, 170. 170 is way up here, so we are deep in the money on that contract. Right, we want to capitalize on this move on Apple. There you go. There's two potential trades if you're interested right now. Long on SLCA, short on Apple. At this point, if you got any symbols or trades you're interested in, I'd be happy to analyze them and give my opinion on them. You know, not every chart that we look at has a good tradable pattern. So, you know, when I go scanning for trades, I have to look at about 10 to 15 charts to get 1 to 2 good trades. So the hit ratio is not high. So don't be surprised if I look at your chart and it doesn't meet my criteria. That's okay. Nothing personal. All right, so just type it in there to the questions or chat area if you are interested in having me take a look at any of your trades. You know, okay. Twitter, absolutely. So Twitter's trying, you know, it's been beaten down. Look, you know, this thing came down from what, 55 bucks. Here it is at 16.89. It is trying to get a retracement. It was, you know, bearish move down. It's trying to get a retracement going. It just can't make it happen, right? I would be interested in Twitter if it could put in a new high above this last one, 20.95. That's a long wait, right? We got to get above the Ichimoku cloud. We got to get some momentum going. I want it to take out this previous high and have some real momentum. So it's interesting to watch Twitter, but it's not ready for a trade for me just yet. JV says, what makes Apple's pull down less than the last one? You know, the last one was a fake out for sure. Okay. What's different is we're losing momentum in the up moves. Okay. We had up moves that were higher. This trend looks like it's losing momentum. So that's a little bit different. Okay. But it definitely could be another fake out. It definitely could be. That's why we use risk management. We're very careful about it. So if it's wrong, we lose very little. Okay. Brad, you are welcome. Microsoft and McDonald's for Joseph. Well, a twofer, huh? You want to supersize your trade request, your analysis request? So, you know, what a great rally on Microsoft. It's just up and away. I do not chase rallies. Once there's a mature in-place trend, I don't jump in. Where's this going to end? You know, I have no idea. I can project a correction. I can project a continuation. I cannot project. You know, I'm a technical trader. I'm not a fundamental trader. So I cannot project where this is going to go to. So what I'll do, my play on Microsoft is when it begins to correct, and, you know, nearly all impulsive trends correct. When Microsoft begins to correct, I'll be looking at a short. We do have some signs we're losing momentum here in this long mature uptrend. So I'll be watching when it starts breaking down. We'll take a look at a short. For me, too long to take the long, too late to take the long, too early to take the short. What a great trend, right? Yeah, you're welcome. Let me, wow, I lost the current questions. This tool is not great at doing that. Because there was another one there that I wanted to look at. Somebody had asked about, oh, it was McDonald's. McDonald's. So McDonald's, you know, you can see I've analyzed it before. There was a nice impulsive wave. There was a perfect correction, and then there was an extension. So it actually met and exceeded the goal. So a little late in this overall sequence. The next move after 5 waves ups is typically in the opposite direction, an A, B, C. I don't really like trading those. I want to trade impulsive and corrective big waves. So McDonald's is kind of played out. We got to let it finish all that before a new sequence would start. You know, what about QQQ? Is going to look pretty much like Microsoft, isn't it? It's the Nasdaq ETF, right? yeah, beautiful trend. Too late to get long, too early to get short. When we do get around to getting short on the Qs, it's going to be impressive, right? There will be a correction, and the Qs will probably lead the other indexes down, but there's no sign of it yet. It's too early, so we'll wait. Okay, I'm scanning for any new questions here. PAA. Let's take a look at it. Hey, you're welcome, Joseph. So PAA, Plains All-American Pipeline. So what we have obviously was a big impulsive down move. We had a correction to it and a new down. And in terms of where we think it's going down to, pretty interesting. So it did correct into the Fibonacci retracement zone. And now we're going to look at the extension of where it may extend to. And so the price extension target zone is about 743. Now the other end of that is negative. Obviously it's not going negative, so the target would be right there, right at the top of that retracement zone. So from 2134, target of 743, there's still some nice profit potentially available there for a short. And the setup looks pretty good. It gapped down, it filled that gap just a little bit, but now it's rolling back off. So I would be looking, get clear of this cloud, and you might have a really nice short entry here on PAA, right? Get clear of the cloud really, really well, and then might be a good short there. Yeah, the Qs do look like they're running out of steam, don't they, Joseph? For sure. Okay, how am I doing? I'm up against the deadline here. Renee said I had a little bit of extra time, but so what if you want to learn some more? What can you do, right? Well, I have a stock options basics course where you can go through and learn. I teach everything, this is basic, right? But I teach everything about puts, calls, the risk of options, what in the money, out of the money is more detail, covered options, naked, intrinsic, extrinsic, more detail, time decay, the Greek values, Black-Scholes, how options are priced, how to use a calculator to project price, basic and then advanced risk management, and an overall options trading plan. So that's on my website for $497. I'm offering that today for $247, so 50% off. And but wait, there's more. If you sign up today, not only will you get the that's a 50% discount, 50% discount on the options. I'll include 30 days in my live trading room and 30 days of my stock and option picks. This is for new customers only. I know I got some subscribers going, hey, it's for new customers only. All right, so what do you get? You get my stock options basic course, which is worth, it sells on the web for $497. 6 modules of written and video training, very comprehensive. I've gotten great feedback on it. You get 30 days in my live trading room, Monday through Thursday, 9:15 to 10:45, hour and a half Eastern time. We do live market analysis, just like I was doing, looking at your trades right now, analyze your trade ideas. We go, what's going on with the market? What are some key levels? And we call out winning stock and option trades in the trading room. They're published and you can come track them, right? I put them up on the website every day. You also get 30 days of my weekly stock and options picks that list on the web for $127. That's 1 to 2 new stock and option picks per week. You get email, SMS, text alerts. We have a live chat, and you get if you like, a one-on-one consultation with me when you sign up. We can get on the phone. We can look at the website, make sure you understand how to use my tools, my risk management technique, and any questions that you have. That comes with a consultation. And so the total value, everything here is $703, and you can get it here during this webinar for $247. That's a 65% discount, and I'll pop a link here into the chat window, so you can click on that. But you can also see the tiny URL on the screen there if you want to take a look at that. So here I'm posting the link, and I'm going to send that to everybody. Make sure I do it right. Okay, that link should be good to go. And TJ, no, I don't use weekly options. I'm more comfortable trading longer term charts. I like trading at the minimum is 30 minutes, sometimes 60 minute, mostly daily stock charts. And so the weekly options way too fast for that. All right. Any other questions? Well, you got me here again. This 247 65% discount. That's only available right now during this webinar. Once we hang up, that's over. You're still welcome to go to my website and sign up for any of these things, but that's a big discount, right? You get the options course, you get 30 days in the trading room, 30 days of stock and option picks. Mirage stock symbol MLCO. Well, let's look at that while we're here. And Renee, just let me know when the time is up. I know you said we could go a little bit over. Tell me when you want to kick me out. I could do this stuff all day. I love looking at charts and talking to traders. MLCO is actually in wave 3 still. It did a little fake out just like Apple, but the overall dominant bullish trend is still going on, and we know that because it's putting in new highs. Okay, so again, unfortunately, too late to get long, too early to get short. Okay, Renee says I can keep going. So if you guys have more questions, if you have more symbols you want to look at, I am at your disposal. And again, well, here's the tiny URL, and I've posted that link there in the chat area if you're interested. Oh, we missed one. Priceline for Nina. Let's go look at Priceline. I kind of avoid trading these super expensive stocks because I published my picks to my subscribers. Oh, I didn't get that right, did I? And people have different account sizes, and trading an $1,800 stock, the option contracts on this are ridiculously expensive. This actually looks like it's in a bearish move with a projected retracement though down 1777 to 1504. So there's a nice short on Priceline right now. It's below the Ichimoku cloud. Nice lower low, lower high. Expect lower low, lower high, lower low, lower high. So Amazon's the same way actually. Amazon looks like a nice correction setting up, putting in new lows. This is nice, right? Lower low, lower high, lower low, right up against the cloud. High probability reverse again, down here into this zone. Sweet. AAPL, American Airlines. Yeah, a bit of a mess. It's gotten very chaotic. Big move up, big move down, big move up. Probably it's chaos. We can't analyze a mess. CMP, and that's the reality, right? I said I have to look at 10 to 15 charts to find 1 to 2 good ones. Compass Minerals, boy, that's breaking down. That's falling apart, isn't it? Again, no clear pattern to that. No, it's not an orderly market that we can deal with. Tap. Oh, on tap, Molson Coors Brewing Company. Well, they're having a bad year, aren't they, in terms of their stock price? All the microbrews are kicking their butt, I think. So, big run up, nearly 100% retracement. It's not as chaotic as the other ones, but what you would want to see is have this channel a while, for a few months ideally, and then a breakout into a new trend potentially. Don't know if it's going to do that or not. What do I think of CVX? Let's see what it is. Chevron. Yeah, we had a pretty good long setup on Chevron. It actually hit the target, right? We saw an impulsive move, we saw a correction, we saw it hit the target zone, and now we said what happens afterwards? A, B, probably a C down, but it's not a tradable thing for me. Okay, Well, I think we're going to go ahead and wrap it up. Thanks for being here. It sure was fun. And again, here's this offer. Again, once we hang up, this one's over. You get $700 worth of stuff. You get the options course, 6 modules, 30 days in the trading room, 30 days of stock and option picks, 65% discount, pretty good deal. So here's the URL, and it is posted in the chat area there.